So, welcome everyone. It is a big pleasure to have today Itamar Drechsler from NYU Business School, Stern, and the National Bureau of Economic Research. Itamar is an assistant professor of finance at Stern, and he is a graduate from the University of Pennsylvania, Wharton, where he did his studies on finance. And Itamar is going to be talking today about this paper on a model of monetary policy and risk premia that is joint work with Alexis Savov and Felice Nagel. So without further ado, please let me welcome Itamar Drechsler.
Thank you very much, Alberto. Thanks very much for the opportunity to present. This is great. I've never done this before, so I hope that I do a reasonable job. Everything goes smoothly. So this is, as Alberto mentioned, joint work with two of my colleagues at NYU, Alexis Savov and Philip Schnabel. This paper, as the title says, is about monetary policy and risk premia. So to set the stage for kind of talking about it, the textbook model of monetary policy, which we all work with and know, the new Keynesian model. In that model, the nominal interest rate affects the real interest rate through price rigidities, and in that way affects the real interest rate. Essentially, all the mechanism in the model works through that channel. The model is largely silent on risk premia. Qualify that a little bit in the sense that there are some models where some institutions are balance sheet constrained, and then changing the interest rate could have an indirect effect through just sort of relaxing or tightening that balance sheet constraint. But the effect is indirect and is absent in most models. However, there's increasing evidence that changing nominal interest rates has effect on risk premia. And here I really want to emphasize the risk premia aspect of things. So there's now a growing body of literature about this. For a very, in my opinion, important paper is the one by Bernanke and Kuttner, which is in 2005 in the Journal of Finance, which showed that monetary policy shocks to the downside, monetary policy shocks of decreases, raise equity valuations. So using a VAR analysis, they showed that the effect is actually quite large. It's, I think, surprisingly large. And more importantly, that the effect occurs through the risk premia. So there's almost none of the effect on the prices is due to the path of the future real interest rate. A little bit of it is due to cash flow, effects on cash flows, but most of it is really about risk premia and expected excess returns going forward. And now recently there's a paper by Mark Gertler and Peter Karate showing similar kind of result on credit spreads. And there's also work by Hansen and Stein on the term premia. All of them showing that surprise decreases in nominal interest rates reduce risk premia. So in the case of Bernanke and Kuttner, increase stock prices, and in the case of Gertler and Karate, decrease compressed credit spreads. And sometimes people refer to this as yield chasing, as the yield chasing phenomenon. In addition, there's work, Adrian and Shin as an example, that suggests that this kind of effects work somehow through increased leverage by financial institutions. So in addition to that empirical evidence, we think that a useful way to interpret a lot of what today's monetary policy does is through the lens of risk premia. So we really think about that as targeting risk premia. So for example, people used to talk about the idea of a Greenspan put, which was that when the stock market falls, the Fed somehow cuts interest rates in order to revive or support prices. And we think that that's really talking about the risk premia component of prices. You have large-scale asset purchases in which the Fed or other central banks buy, in particular, risky assets. And then other things like Operation Twist, which was about long-term or riskier bonds with the term premia, buying those versus short-term bonds. So you think sort of an umbrella framework for thinking about all those things is that really they look like they're different programs and maybe different segments of the market, but they're targeting they're all targeting, at the end of the day, risk premium. And so we're asset pricers. We come from a finance perspective. And what we're interested in doing is building a dynamic equilibrium asset pricing framework for thinking about how monetary policy can affect risk-taking and risk premia and some of these features. So let me get into an overview of the model. In the model, the central bank sets the nominal interest rate in order to regulate the economy's effective risk aversion. I'll be precise about that. And it kind of regulates aggregate risk aversion by changing banks' cost of leverage. It's a simple, in the main model, it's a simple endowment economy with two types of agents. These agents differ in their risk aversion. So there's a group of low risk aversion agents, which you can think of as risk takers. And these risk takers, we think of them as pooling their wealth together in order to take risk as the equity capital of banks. The second group, the higher risk aversion agents, there we think of them as depositors. So the reason is endogenously in equilibrium, they're going to not want to take risk as much as the first group, and so they're going to risk share with the first group. They're going to lend money to them through instantaneous risk-free bonds, which we think of as deposits, and so they're going to delever, while endogenously the risk takers in the form of the banks take leverage by borrowing these deposits. Okay. And all of that up to this point is frictionless, except we add a friction, which is we require the banks to hold fractional reserves against the deposits. So this will impose a cost on taking leverage. It's going to make taking leverage somewhat more expensive. And we don't micro-found the rationale for doing this, but I think that could be easily done. And there are multiple stories one could have in mind, all leading to a requirement or a want to put impose a cost on taking leverage. So a typical one is that banks do not internalize the full cost of their risk taking because it's not imposed on them by depositors due to deposit insurance. And the rationale for that is often in kind of Alan Gale models is that there's a coordination problem among depositors, leading potentially to costly runs. The government provides deposit insurance. In so doing, they break the price mechanism for banks, as I just mentioned. Banks don't have to fully internalize the cost of their risk taking. And then there's a role here for a kind of a regulation or intervention to mitigate this externality. But you can have other kinds of externalities as well. For example, a popular one people have talked about recently are fire sales arising from too much leverage, also an externality. And in any of these cases, you have potentially such a role. And then, as Stein has pointed out, a nice aspect of reserves is that you can see the cost of that constraint, which will show up endogenously as the nominal interest rate. It can be observed as a price, a shadow price of that constraint, and which can be used in deciding how tight to make that constraint. There's no nominal price rigidities in the model, in the main model, so we don't use that friction. Now, the central bank controls the cost of holding reserves. It will turn out endogenously to be the nominal rate. And what that means is that when the nominal rate falls, leverage becomes cheaper. When leverage becomes cheaper, bank risk-taking rises. So the overall demand for risk in the economy rises, pushing down risk premia and also the total cost of capital. Okay, so that's the kind of the mechanism. And we solve also for the reserves dynamic that implements such a nominal rate policy. And so that's the basic framework for it. Okay, now another way to look at this, which I really want to emphasize, which we think of as the essential mechanism of the model, it's kind of a high level, is, and I'll show precisely how this alternative interpretation comes out, is that the nominal rate affects banks' external finance spread, or that's one term that literature uses. Another term you could think of as the cost of leverage spread. And in the model, and often in empirical studies, one way that this is measured is the difference between the federal funds rate and the rate on a risk-free bond, which in the model is equivalently either treasuries or deposits. So this spread is the spread that the federal funds rate being the rate that banks pay for unsecured credit to take leverage. So another dollar of external financing to take leverage versus the rate that's available to investors on the outside for to put into a risk-free bond. And this spread will exactly be what we'll show can be viewed as the cost that is imposed on banks' leverage taking. Okay, in the main model, we obtain this spread via a friction on the asset side of banks' balance sheet in the form of reserves. We've also worked out a channel which we like. We've left it for now, at least, to the appendix, where the cost comes on the liability side in causing the spread to come out. And in that case, what happens is that the nominal rate affects the spread that banks earn on taking deposits. So I'll just say something briefly, which is there is a literature showing that deposit rates are quite sticky, so that the spread that banks earn on those is strongly connected to the level of the nominal rate. And then what you get through that channel is that the cost of the liabilities is affected by the nominal rate, and that affects leverage taking. Okay. Now the graph that I have here is one which looks at this in the data. So so let me describe quickly what it is. So in red you have the federal funds rate, the level, and in blue you have the spread between the federal funds rate and the Treasury bill. So again, think of the Treasury bill spread as the risk-free rate available to regular investors, or and the federal funds rate is the cost that banks pay for taking getting extra external funding or leverage. And as you see here is that this spread and the level of the Fed funds rate are very strongly related to each other. So over almost a 30-year sample here, ending before the crisis, you see that they track each other closely, not just in the trend, but also in the cycle. Indeed, the correlation between them is close to 90%. So to the best of our knowledge, we're the first ones to look at this relationship. And we think that this is very compelling evidence that the level of the nominal interest rate can affect banks' cost of external financing or leverage. And then if you take the structure of the model, which is take banks as the risk takers in this heterogeneity and risk aversion, in combination with the rest of the model, whatever channel gives you the relationship you see here in the graph will generate the rest of the risk-taking and risk premia dynamics that we have. So whatever channel you like, either the liabilities channel or the reserves asset side channel that I'll present, as long as you get to this relationship, if you have the rest of the structure of the model, you'll get the effects of monetary policy on risk premia that we have. And so we think this is very compelling in that respect. This paper is, and I'll come back to this to say how this is exactly generated inside the model. Just quickly say something about the literature. There's many strands of the literature on which our work builds. They come from both macro and macro finance, and also the banking literature. So there's kind of the credit view of monetary policy, which nowadays is very important. Think of Bernanke, Gertler, and Gilchrist. There's another literature on the bank lending channel, the idea that bank lending, that the nominal interest rate affects the amount of bank lending, and it's important, has important real effects through that. There's another literature on government liabilities and their importance in terms of driving borrowing costs and risk premia. And then there's the literature that I mentioned, more recent growing literature on studies of how monetary policy can interact with asset prices. And I encourage anybody who hasn't looked at the Bernanke-Kuttner paper to look at that one. I think that's an important observation. And on the more financy side, there's a lot of papers on how constraints on institutions and leverage taking are important for asset prices. Okay, so to get into the formal setup, there's an aggregate endowment, D, which follows just a very plain vanilla IID dynamics in continuous time. And there are two agent types, as I mentioned. A are the risk tolerant ones, and B are the risk averse. They have sort of standard recursive preferences in continuous time. So what people think of as Duffy-Epstein version of Epstein's-in preferences, just normal recursive preferences, which let you have both risk aversion separate from intertemporal substitution. And we have both agents having exactly the same type of preferences. The only difference between them is the risk aversions. So agent A's risk aversion is lower than agent B's risk aversion. Okay. And this creates endogenously a demand for leverage or risk sharing. As a result, the single state variable in the main model is the wealth share of type A agents out of the whole economy. And so you can think about this as sort of the bank capital share, or the share of wealth held by risk-tolerant agents pooled into bank capital. And that's what's going to drive differences over time in the model. In terms of assets, there's basically three assets. First, there's a claim on the endowment. So think of this as a claim on aggregate consumption, which is a risky claim because aggregate consumption or aggregate dividend has a risk to it. And it has the following return process, which we solve for endogenously as part of the equilibrium. That's a function of the single state variable, the wealth share of risk of the type A agents. In addition, there's instantaneous risk-free bonds, which, as I've mentioned, we think of as deposits. Those pay the real risk-free rate R, which we solve for also as part of the equilibrium. Now, as I mentioned, depositors are going to endogenously risk trade or risk share with the risk takers, and they're going to do that using these instantaneous risk-free bonds. They're also going to hold some of the risky asset, but the banks will hold more than 100% of their wealth in the risky asset. Now, the third asset that we have are reserves. So banks must hold, so this is the friction now, banks must hold the reserves in proportion to the amount of deposits that they take. So to make this formal, suppose that let WS be the risky asset portfolio share of an agent, and then WM be the share of the portfolio that's held in reserves. Okay? So then the requirement is that WM be greater than this quantity right here. So this quantity right here, which is the reserve requirement. So the first thing in brackets, WS minus 1 is the amount of leverage that you have, multiplied by lambda sigma squared, which is the reserve requirement. Now, you can think of just lambda as the reserve requirement. The reason that we scale by sigma squared is simply for analytical simplicity. So as I show, sigma squared here, which is the diffusive variance, scaling it in this way allows a lot of the expressions that we have to be very simple and the economic intuition to come through. It's not necessary or qualitatively very important for anything that we're doing. In numerical solutions, you can get rid of it, but it makes the expressions come out very neat and intuitive, as I'll show you later. Okay, so that's the reserve requirement times the amount of deposits that you take. You have to hold at least that much of your portfolio in reserves. Okay, and the zero is here is simply because you cannot short reserves. Only the central bank can create reserves. Okay? So that's the reserve requirement. Now, the central bank adds or removes reserves in the model from circulation by buying or selling bonds, risk-free bonds, at market prices, so in a revenue-neutral way. And we think of those as open market operations. Okay. So there are MT reserves at any given time, and the central bank sets the characteristics of their dynamics, their law of motion, based on its policy. And we solve for the policy that we want. So it gives them this following law of motion, which can depend on the state variable. Now, in equilibrium, each dollar of reserves is worth some units of consumption. That's solved for. We take reserves to be the numeraire in this economy, just like in reality, dollar bills being the numeraire. So if each dollar of reserves is worth pi t units of consumption, pi t is really the inverse price level. Okay, so it's the inverse of the price level, And so what we're going to get here is prices are endogenous, and actually inflation is going to be endogenous. Now, what is inflation? Inflation is negative the change in pi over time. And what another simplifying assumption we make is we restrict the central bank to choosing the dynamics of the quantity of reserves so that inflation comes out to be locally deterministic. That is, if you see here, inflation, the change in pi, the inflation doesn't have a diffusive term. So locally, inflation is deterministic. That's just a simplifying assumption we make. So you know what inflation is going to be over the next instant. You don't know what it's going to be the instant after that. So there's uncertainty about inflation, in the future. But at least in the next instant, things are simple and deterministic, and that just makes everything go through simply. Again, it's not really crucial to anything. Okay, and then, given this endogenous inflation, we define the nominal rate the way you would expect, so that the nominal rate is equal to the real interest rate plus inflation. Okay? And we actually take the nominal rate to be the central bank's policy. Okay, so in the model, when I show you examples, we're going to assume a certain central bank policy as a function of the state variable, and we solve then for how the central bank implements it in the background. But that's going to be the central bank's main policy tool. And we assume rational expectations. We assume agents know the function mapping the wealth share, the state variable to the central bank's policy. Okay. Now, to close the model, we have to do something with synerage. So because the central bank creates reserves here which have value by fiat, simply by making a requirement about reserves, then they get synerage. So as we show, synerage here is equal to the total value of reserves. Synerage profits per period are total value of reserves, so that's MT times pi t, times the nominal interest rate. So the amount of synerage flow is that amount. It's always positive. And to close the model, we have the central bank simply refunding synerage profits to agents in proportion to their wealth. So that makes the wealth dynamics invariant to this, so it doesn't affect the wealth dynamics in any way. It's the simplest way you can rebate back the synerage profits. Okay, so now we want to solve. So Alberto is asking why the Fisher equation is a function of type A's wealth share. Actually, let me just then take a step back. This is, at this point, I'm simply defining the nominal rate to be equal to whatever the real interest rate comes out to, plus whatever the inflation comes out to. So I'm simply saying that's what I define to be the nominal rate. As you'll see later in a slide or two, that will show up in expressions exactly as you would expect the nominal rate to show up. So it's going to be consistent with what we think of as the nominal rate. The reason that it's a function of omega is simply because the real interest rate is a function of omega based on the wealth. Everything is just a function of omega, so are the real interest rate and inflation, and so the nominal interest rate will be a function of omega. Now, as I said underneath, we're actually going to sort of do things in reverse. We're going to say that the central bank is going to implement the nominal interest rate as a function of omega. We can specify any function we like. I'm going to look at very simple ones. And then we solve for what they need to do to the dynamics of reserves, that is up here, okay, in order to get that to actually be the case in equilibrium. In other words, it's going to do things to the drift and the diffusion of the reserves such that the nominal interest rate comes out as we had asked it to come out. Okay? And the nominal interest rate is defined as the real interest rate plus inflation. So to take a step back again, remember there's just a frictionless economy here with one friction, then add one friction added. There's these two agents with different risk aversions. They can trade risky assets, the risk-free bond, and they can hold reserves. The central bank is the only one who creates reserves, and everything. And then there's the reserve requirement. Everything else is endogenous. And we allow the central bank to pick the nominal interest rate policy that it wants. And there's only one state variable in the model, so it has to be specified as a function of that state variable. I'll look at some static policies and dynamic policies later as applications. Okay, so now we're solving for the equilibrium that comes out of this. So the HJB equation here, solved by each agent, looks like this, which is standard. And it is subject, so the non-standard thing is it's subject to the reserve requirement on the agent's holdings of reserves. And then it's subject to the wealth evolution equation. So I put this up because I want to show the difference in the wealth evolution relative to a standard model. So most of it is the same. So wealth evolution, wealth evolves as the real interest rate, which is standard, minus, so C here's the consumption to wealth amount, so the fraction of your wealth you consume, so that's in here, that's standard. And then here's your holdings of the claim on the endowment, the risky asset. So in the typical way, we write this in excess return form. So the component here is your weight in the risky asset times the excess expected return on the risky asset. And then, let me jump for a second to the last term. Here is the diffusive part is your weight in the risky asset times the volatility of the returns on the risky asset. Okay, all that part is kind of standard. The part that you get here that's new is it's kind of deleting this. Hold on a second. So the part that you get here that's new is the part that's under brackets. So it's the weight in reserves, that's WM, times the excess return on reserves. Now the excess return on reserves is the capital gain of reserves, that's d pi over pi, that's the amount that their price goes up, minus the real interest rate. Now if you'll recall from the previous slide, that's just minus the nominal rate. So you get here what you sort of should expect to get is that holding reserves has an excess return minus the nominal rate. In other words, holding reserves is costly because they earn minus the nominal rate. It is an excess return. Okay, and that's why it's a drag to hold reserves. And that's going to impose a cost on taking leverage. So minus n is the excess return on reserves. So now the thing that we call the nominal rate exactly comes out as the return on reserves endogenously. And so that makes sense to define the nominal rate in that way. Okay? And then there's one other component here, which is this GN. That's just the synerage payment per unit of wealth that's refunded to the agent. So that has to also be in that wealth evolution equation. Okay, so we solve this thing. Let's look at some of the optimality conditions of each of the agents. Okay, so each agent's value function has the following form, where what you have to solve for is J. J is a function of the state variable. And we write it in this way simply because then J comes out to be the optimal consumption choice. Now, what does the first order condition on risk taking look like? Now I'm going to look at the first order condition of agent A. Okay? So the first order condition of agent A looks as follows here. And that has sort of two usual components and one new one. So the first component, mu minus r over sigma squared, is the usual myopic investment opportunity. That's the expected return over the variance, and that has a 1 over the risk aversion in front of it. So the agent A's choice of how much to put in the risky asset has that usual sort of investment opportunity set component to it. The last part, which looks complicated, is also standard. That's the hedging motive of the agent. So as investment opportunities change over time, there's some hedging component, but that's standard. The part that's not standard is the part in red. Okay, so what you see here is the effect of the nominal interest rate. So if agent A chooses to take leverage, and I'll describe in a second the simple condition under which that holds, then you see an additional component here, which is the reserve requirement lambda times the nominal interest rate. And you see that decreases the agent's holding of the risky asset. So what that means is raising the nominal interest rate imposes a greater cost on taking leverage. Banks choose to take less risk, that is WAS goes down. That decreases aggregate demand for risk taking or increases aggregate effective risk aversion, which leads to an increase in risk premia. Now, the condition for this to be the case is very simple. So agent A has this condition so long as this part here is met, so long as the cost of holding reserves, that is lambda times n, is less than the difference in risk aversions. So remember that agent B is more risk averse. That creates a demand for risk sharing. So long as that demand is big enough, gamma B minus gamma A is big enough, there's a strong demand for risk sharing, and the banks are going to take leverage, and they're going to have the first order condition I showed you here. Okay, they're going to be willing to bear the cost of the nominal rate, the friction, in order to take leverage, and the nominal rate is going to have an effect. Now, it's possible that if the difference in risk aversion is the demand for risk sharing is not big enough, that's condition 4, then actually neither agent takes leverage, and they're essentially in financial autarky. They don't share risks. But we're going to parameterize things in a way that to be interesting so that they do. So we're going to have to choose the risk aversions to be sufficiently different to create a risk-sharing motive. Okay, so now I'm going to get back to this idea of the external finance spread and kind of the main mechanism that's driving the model, the way to look at it. So there's if you think about Fed funds in the models, Fed funds market's a big market, and it's a market for borrowing funds unsecured between two banks. There's no reserve requirement on Fed funds in reality. So now if a bank is thinking about borrowing another dollar, either from depositors or Fed funds, well, in depositors you have the reserves requirement, which is costly. In Fed funds you don't. So to make the bank indifferent between those, the Fed funds rate has to be a little bit higher than the deposit rate. So indeed, it has to be higher by the cost of the reserve requirement. So that means that the real interest rate on Fed funds is the real interest rate on the outside, depositor or T-bill interest rate R, plus the reserve requirement times the nominal interest rate. And so that means that this quantity here, the reserve requirement times N gives the spread between Fed funds and a risk-free bond. And that gives you an idea of how costly it is for the bank to obtain another unit of external funding via the Fed funds market. So this is the premium banks pay for external funds. And we can rewrite the first order condition in the previous slide, which was for a constrained portfolio choice problem, as an unconstrained problem, one that doesn't have the constraint, but then we have to change it a little bit. So really, here's what it looks like. And all that happened here is I took the component that was minus lambda n and put it back into the numerator of the first component. And what you see is, as an unconstrained problem, the bank faces an interest rate that's not R, but it's R plus this Fed funds T-bill spread. In other words, viewed as an unconstrained problem, the bank faces the Fed funds rate as its borrowing rate, not the deposit rate. And what that shows you is that the central bank can regulate risk-taking by influencing this external finance spread via N. By increasing N, they increase the cost of external financing or leverage. Making leverage more expensive makes banks' demand for leverage goes down, increases aggregate effective risk aversion, and increases risk premium. So that is, in a nutshell, the way that we view the basic mechanism that needs to work in the model. And we got this expression from an asset side friction, but as I mentioned before, we've written a version where there's a friction on the liability side that we work out, which is the spread that banks can earn by giving deposits, and that leads essentially to a very formally similar equation. And so that's why I highlight that the main thing is that N needs to increase the cost of levered financing. We get a similar expression under that different channel. So now let's go back to the empirical relationship that I viewed. So in the model, the Fed funds Treasury bill spread is simply proportional to N. It's very simple. And so very strongly with N. As I mentioned, if you actually look at the data, I think the relationship is quite striking. So I think it's rare that, again, this is a level of the Fed funds rate against the spread between Fed funds and T-bills. So I don't think, I've had discussions about this, I don't think that there's anything mechanical here, given that one is a spread and one is a level. But I do find it very striking that they move so much in tandem. And again, if you sort of give me this relationship for starters, then I think with the heterogeneity and risk aversions, it seems to to me to be very sort of a compelling argument that raising then n increases the external finance spread, as you see here empirically. With heterogeneity and risk aversions, it would have an effect on aggregate leverage and risk taking. Okay? And what, to be specific, the graph involves is smooth. It's 20-week moving averages, and the correlation between the two series is 86%. One thing I want to emphasize is this is the spread between two very, very safe rates. I think essentially both of them are viewed as risk-free, but the average spread over this period is 57 basis points, which, given that they're both very short maturity, very, very safe rates, to me, it seems like a very significant rate. By comparison, the Moody's credit spread over this period is about twice as big. So that's a spread between risky bonds and low-risk bonds. I think that this is an important channel that's operating at the level of risk-taking between the nominal interest rate and institutions' cost of leverage. Okay. Now, to fully illustrate the model, we have to pick some parameters for the model. The model doesn't permit closed-form solutions for everything. So we solve it numerically. We use global methods to solve the model over the full range of the state space. So the parameters we pick here are mostly standard with a large difference in risk aversion. So we pick that the risk aversion of the banks is low, 1.5, whereas the risk aversion of depositors is relatively high at 15. This still creates a large demand for risk sharing. And we set a high rate of intertemporal substitution. This magnifies some of the effects. And then for the endowment, in terms of both growth and volatility, we pick standard values of 2%. We pick a reserve requirement that's like the one in the US on net transaction accounts of 10%. And then I'm going to show you the equilibrium over two different nominal rate policies. One that just keeps nominal rate at 0. And the nominal rate at 0 is at 0. It's as if there's no cost to reserves at all. So essentially, it's as if the reserve requirement wasn't there. The alternative is we'll look at a high nominal rate policy of 5%, in which the constraint binds quite tightly. So, okay. So let's look first at risk-taking in the economy. So that's the risky asset share of the two agents. Okay. So what I'm graphing here is I'm graphing the equilibrium outcome against the state variable in the model. That's the bank wealth share. Okay? So think of high bank wealth share, omega of 1, as banks owning everything. Very low bank wealth share, 0, is if they're not there. And blue is the 0 nominal rate policy, and red is 5%. So this is a very simple static nominal interest rate policy, which is the same for all values of bank wealth share. Later, as an application, I'll look at one that's dynamic, that changes. So what you see here is, as the first order conditions indicated, as the nominal rate increases, bank leverage, that's the bank wealth share, the bank risk taking here, WAS, falls. And as a result, somebody has to hold the risky assets, so depositor risk taking increases. So this reduces risk sharing and puts more of the risky assets in the hands of the higher risk aversion agent. So this increases the effective risk aversion of the marginal investor. Okay? The effects differ depending on the state variable. A lot of times what I'll focus on is ranges of the bank wealth share that are kind of intermediate, say between 0.2 and 0.4, which is the range where kind of the banks are significant in terms of their total risk-bearing capacity, but haven't taken over the economy. So we think of that as kind of being the reasonable range to look at. And so the kind of depositors and banks are in the same order of magnitude in terms of ability to, total risk-bearing capacity. You see you increase the nominal interest rate and bank leverage falls, and depositors have to pick up the slack. What does that do to the price of risk and the risk premium? So as you would expect from what I've said, the price of risk in the economy, so the Sharpe ratio goes up when you increase the nominal rate. And also on the right-hand side, you see that the excess return, the risk premium, goes up. Okay, so this is exactly capturing this kind of notion that people have of reaching for yield, but which is or yield chasing, which is as nominal rates, now think about it going the other way, as nominal rates go down, the risk premia go down, and price of risk goes down, and previously, from the previous slide, leverage goes up. So the model sort of generates a mechanism that's like that. Now, in terms of the numbers, we're not really taking this as a quantitative calibration, though we picked numbers we think are not crazy. But the numbers you are looking at here, remember, are the risk premium on a claim on the full endowment. So people sometimes say, this risk premium looks small, but this is not like stocks. This is a claim on the full endowment. And if instead you look at the Sharpe ratio here, these are Sharpe ratios that are very typical for risky assets. What this, of course, means is if you have a very risky asset like a stock, you would scale up all the risk premium quantities by the amount of volatility. So just multiply it, and then it would look like the kind of risk premium we talk about for stocks. Let's take a look at volatility. So volatility has interesting dynamics inside the model and as a result of interest rates. So if you look at the high interest rate volatility, it's very flat across bank wealth share and is around 2%, which was fundamental volatility. That was the volatility of the endowment. However, when interest rates are lower, there's a lot of excess volatility. So volatility is much higher, substantially higher than the endowment volatility. And in addition, what happens is, so why does this happen? Well, at lower interest rates, there's more leverage in the economy. And as a result, any particular shock to the endowment gets magnified in terms of its effect on the wealth distribution. So banks take more leverage. If there's a shock, their wealth moves by more. Because discount rates depend on the bank's wealth share, as I showed in the previous two slides, discount rates will change a lot for any given shock when interest rates are low. And that creates a lot of volatility. And actually, there's even more than that. The effect is counter-cyclical. So when you get a negative shock here, bank wealth share is going to go down. That's going to increase discount rates. Also, when nominal interest rates are lower, if you remember the previous two slides, then actually everything in the economy is more sensitive to the level of the bank wealth share. So not only does the bank wealth share move more, but everything is more sensitive to that bank wealth share. So everything is just moving around more, and the effect is being compounded. Whereas at high interest rates, there's very little in the way of leverage or risk sharing, so there's really things are not very sensitive to the wealth share, and the wealth share is not changing very much. Okay. So if you think of volatility as something closely related to financial stability, then in that regards, the model says that low interest rates lead to more financial instability. Of course, there is an upside in terms of risk sharing. I showed you that risk premium go down when interest rates are lowered. The question is, perhaps a more relevant question is what happens not just to risk premium, but the total cost of capital, because that at the end is what we think of as affecting investment. And the total cost of capital then does the same thing, actually. So that's reassuring. So here what I've graphed is the valuation of the endowment claim, so the wealth to consumption ratio. So that's, if valuations go up, it's as if it means the cost of capital went down. And what you see here is that when the interest rate goes down, the value of the endowment claim goes up. And that happens at every level of bank wealth share. So you go from the red line to the blue line. So total value of the claim, of total value of capital increases. And if you have production, in a model, then having the value of assets go higher is going to lead to increased investment. And I'll show you something in a second about that. I do want to say something both here and in the previous slide about the sensitivity of these effects to the particular value of the state variable. So if you see, in many cases, the effects here in volatility, and the next slide on the cost of capital are the biggest in the range, in the area where the bank wealth share is kind of intermediate, not too big, not too small. And let's go back to volatility. And in that case here, it's really at around 0.2. And that's, like, as I mentioned, banks here, they'll hold 20% of the wealth share. So they're a minority in that regard. So because they take a lot of risk per unit of wealth, that's around the range where they and depositors have sort of equal weight in total risk-bearing capacity. And so it's really at those values where changes have the biggest effect on total risk sharing and total amount of risk taking. And so you see that also in the effect of interest rates on total valuations, that they're biggest in that range. So let me try to understand the question. This result of lower nominal interest rate leading to more instability. So I didn't understand the last part.
So usually, sometimes when people think about this risk-taking channel, is these very low interest rates make banks to search for yield, and in that sense to change the pool of borrowers to which they are lending money. But you don't have that story here, in the sense that
I think in a way, yes. I mean, banks here, their cost of at the margin, their cost of taking risk has gone down. So they're going to seek risk even when it has a lower expected return than it otherwise would. So that could mean taking more leverage. It could mean using the existing leverage to take to lend to riskier projects or buy riskier assets. The essential thing in the model, there's only one type of asset, so there's kind of no differences in the cross section. So you can't switch from more risky to less risky borrowers. But the point is that they are willing to take more risk and want to take more risk. So it does have that. Now, what it doesn't have is they're not doing this as a result of ignoring risk, or they're not doing this because of an agency conflict. They're not doing it for that reason. And I can sort of on the side comment about, I have a view on that sort of view too. Some people have an agency view. So it's not risk shifting or ignoring risk. It's simply that the cost of taking leverage has gone down. Now, as I mentioned, one of the motivations for putting a friction on leverage taking could be that banks either do not price into fully the deposit guarantees that they get, and in that sense there is risk shifting. So that could be sort of lurking in the background. It could be that they ignore fire sale externalities. It could be any of those things, but conditional on that, they're not doing another level of sort of ignoring risk or risk shifting. But it could be that the reason for having this in the first place is some failure to price an externality correctly. Okay. So as I said, so lower interest rates cause the total cost of capital to go down, the price of capital to go up. So while what we do here is essentially an endowment economy, we did consider what would happen if you added production. So to the benchmark model, we added production and capital accumulation subject to kind of standard adjustment costs. So I'm not going to go into the details too much, but this is kind of down here a standard capital accumulation equation with adjustment costs. So you put in investment, but at the margin you don't get a unit back of extra capital. You get a decreasing number of units of capital as you add more and more investment. And so that's kind of a standard production sort of dynamics. And then the question is, would in such an environment interest rates affect investment? And so the first order condition for investment is very standard. It's Q is the price of a unit of capital, invested capital, so that's basically valuations, times the marginal benefit of a unit of investment. So that's the phi prime here. So that's the usual equation that the net benefit of another unit of investment equals 1 at the margin. And you can see that when the price of capital goes up, as it would if interest rates go down, then you are willing to put in extra units of investment until this first order conditions holds. So that means that lower nominal rates, by leading to higher prices of capital, lead to greater investment. And what you see in the plot is precisely at the low in the high interest rate. So when you go to the low interest rate, the blue, what we have here is sort of net effective investment that goes up for every value of the state variable. So lowering interest rates in a production setting would lead to more investment in this. And if you thought about cross-sectional effects, I think that would be interesting, because assets that, just to get also to Alberto's point, assets which would load more strongly on risk, that would be more sensitive to the risk premium, would have a bigger effect on their price, and therefore investment in more risky assets would be more affected by the decrease in interest rates. Okay, so in terms of static applications, then that's the static application. So now I'll talk a little bit about dynamic applications. So with dynamic interest rate rules. So here the setup really, the framework that we have really lets you do some interesting things that you really need the dynamics for. And so first thing I want to talk about is an interpretation of our interpretation of the zero lower bound. So now when the nominal interest rate is 0, then remember the nominal interest rate is the shadow cost of the constraint on leverage taking. That means that there's no cost to taking leverage. So that means banks take as much leverage as they want. Now, they don't take infinite leverage because they do care about risk somewhat. They have a low risk aversion, but it's not 0. So they just take leverage up to their unconstrained optimum. But that means that that there's no scope for increasing their leverage and in that way raising prices by locally decreasing the interest rate. So because banks can't be forced to take more leverage, and the constraint is a one-sided constraint, you have to hold reserves if you take leverage, but you can't be forced to take leverage, then the nominal interest rate can't go negative by no arbitrage. If you try to make it go negative, there's an arbitrage there. Reserves are riskless. And so at a 0 nominal interest rate, banks would be willing to hold large amounts of reserves, excess reserves, since there's no cost to this. They're just like treasury bills. Okay. If, like today, there's actually a little bit of an extra kick you get, a little spread you make, then in fact, will be willing to hold as much reserves as you like. Okay. So that's our interpretation of the 0 lower bound inside the model. Basically, at that point, they're happy taking as much leverage as they have. And the question is, can the central bank still do anything to sort of raise asset prices further in some way through the conventional monetary policy by doing something with interest rates? And the answer is they can do something like our interpretation of forward guidance, and they could do this by changing the expected path of future nominal rates. So now instead of just having a policy of interest rates which is always the same, we can think about changing expected future nominal rates and see the effect on prices. So here's our interpretation of forward guidance. So think about two different interest rate policies, the blue and the red, and consider that the state where we're in a sort of a crisis state, which we're interpreting that as omega being low, so bank wealth share is low. In this case, think about omega as being in this region here, so below 0.2. And now consider the two different types of interest rate policies. One is the red, where the central bank promises to keep rates at 0 today, at the 0 lower bound, but will raise them when bank wealth share recovers sufficiently to this point right here, 0.25. And it's going to raise them back up. Okay. Forward guidance is the alternative potential policy, where instead they promise not to raise interest rates until bank wealth share recovers even further in the future to 0.3. So today we're still at 0, so the two policies are the same today, but they're promising to only raise rates when bank wealth share recovers even further. Okay. Now the question is, what does that do to prices today when we're back in this region here? Okay, so, and what you see that on the right-hand side here. So this shows you the ratio of the risky endowment claim under the forward guidance policy relative to the red policy. And what you see is that prices are higher under the forward guidance policy, even in this range here. There's a substantial difference in the value of the total endowment, even when interest rates are below, are just at 0 today, the same as they would be under the alternative policy. So the central bank can increase risky asset prices today just by changing expectations of future rates, even though rates today are stuck at 0. You see, actually, it raises the value of risky assets everywhere, but in particular even today. The second application that I have in mind, which is my favorite, is our interpretation of the idea of a Greenspan put. So this is something people talked about a lot before, and maybe they'll talk about it again, or sometimes they call it the Fed put, to be a little bit nicer to Greenspan, which, as I'm sure you all know, is the idea that the Fed will cut rates if there's a sharp drop in stock prices in order to, quote unquote, support prices. Okay, so this idea that the Fed gives holders of stocks, risky assets, kind of a put. So somehow the notion goes that if something bad happens and stock prices drop, the Fed will step in to decrease interest rates and therefore cause asset prices to at least go up somewhat back. So support asset prices. So our interpretation is the following. So as a benchmark, take the red policy, which just has a constant interest rate at 4%, and consider instead the blue policy, which is higher in sort of good states when bank wealth share is high. We just have it higher so that on average interest rates are the same. But when we get to a certain point where a number of negative shocks drives bank wealth share down, then the Fed starts to cut rates. So as we drop further below this point, the Fed cuts rates further and further. So they start to cut rates as past some set of negative shocks to support prices. Okay? So rates are lowered in response to large negative shocks, that is, shocks driving wealth share below 0.3. And in fact, you know, the blue policy kind of looks like a put option. It has the shape of a put option, which is flat and then kind of going down. It's almost, you know, graphically looks that way. And let's look at the value of the consumption claim, the endowment claim, the risky asset. Well, its valuation under the policy is the blue, kind of looks like the red one plus a put. So as bank wealth share goes down, the blue policy, unlike the red policy, starts to become around the point of the dashed line where the put kicks in, very safe. So you see around this point that the blue line is very flat in the bank wealth share. Okay? So what that means is around the part where the Greenspan put policy kicks in, think about around there, well, if you get a positive shock and bank wealth share goes up, then that's kind of good news. But if you get a negative shock, it's not really bad news either, because the Fed will support prices by lowering interest rates, allowing there to be more leverage and driving risk premia down. So you're kind of in this range where the asset is very safe, and there's no real bad news. And that's the idea of this Greenspan put. Now, the other effect of that, though, is that this is occurring through increased leverage. The leverage during this time is going up. But at some point, banks become satiated, especially since further negative shocks are sending their wealth share down. They don't want to keep taking more and more leverage. So if you continue to get even more negative shocks, prices come crashing down. So you see how the blue catches up to the red. There's a steep drop in prices. So because prices are propped up by increasing leverage, in a sense, if you get a bunch of further negative shocks, it causes valuations to fall more quickly. So this captures the notion that people had that the Greenspan put gives you some short-term stability, but potentially at a cost of long-term instability if we continue to get bad shocks. You see that here, and you can see it by looking at some other quantities. So in particular, if you focus on volatility under the Greenspan Put policy, it does kind of interesting things. So volatility is very low around the point where the put kicks in. In fact, volatility goes down below fundamental volatility. But then further negative shocks sends volatility spiking under the Greenspan Put policy. So again, this is kind of longer-term instability coming in. Okay. And you see, again, risk premia around the put policy drop a lot, but then increase a lot as instability kicks in. Okay. The last thing I'm going to do is we extend the model to think about nominal interest rate shocks. So up to now, everybody knows what the policy rule of the Fed is. It's a function of the state variable. You don't know what it's going to be, but if I told you omega, you would know what the interest rate would be. We wanted to think about policy shocks. One reason to think about policy shocks is also to get an accelerator effect, like in a Bernanke, Gertler, Gilchrist model, where there are effects on the distribution of wealth from changing interest rates. Okay, and that has involved sort of surprising people. So what we do is we extend the model to incorporate a second state variable, which is the unexpected shock. Okay, so there's a benchmark rule which the central bank follows that people know, just like before, but they can deviate somewhat from the rule, which is the shock. Okay, and then you can look at what happens if there's a shock increase in interest rates. So what happens here the first thing we want to show is that this shock now causes some wealth effects. So if you look at the post-shock wealth share of an increased shock, you go from the blue to the red. What this shows is that when interest rates go up, because of the effect that they have on risk premium and prices, well, prices change. When prices change because the banks are the ones taking leverage, then their wealth goes down more. So the wealth distribution shifts away from the banks, causing this wealth effect. And that wealth effect adds to the direct effect that I've been showing to create sort of a second round of effects, an accelerator effect, which then further changes prices in the same direction. So we can look at that in this graph. If you go from the blue and there's a positive shock, well, the direct effect I've been showing you goes towards the dashed red line. This is without changing wealth. And then because of the decrease in wealth, you have the second round of effects, which further pushes valuations towards the red. Okay? So the total impact in valuations of a shock exceeds a known increase in the interest rate due to the wealth distribution or balance sheet effects, and has an increased total impact on valuations. Okay, so to conclude, the takeaways, we think that contemporary monetary policy targets risk premia, not just interest rates. So maybe if I want to have my main big picture point, which I started this with, is we think that monetary policy has interesting and important effects on the risk premium component of the cost of capital. We think that modern monetary policy is targeting this risk premium component, and that many of the programs that are instituted can be thought of as essentially through that lens in a kind of coherent and unified way. And so we want to create an asset pricing framework for studying the relationship between monetary policy, leverage, and risk premia. In the model, the sort of big picture way to think about it is that the monetary policy influences the cost of external finance, which is, or equivalently, levered finance, and therefore changes leverage and total demand for risk in the economy. In that way, it has effect on risk premia. And this framework allows us to look at dynamic applications, such as the two that are presented for guidance in the Greenspan Put. That's it. Yeah. Yes, I think price rigidity would help. So what price rigidity would do is actually I can show you something in. So one thing I didn't talk about, I'll talk about it now, is so the risk-free rate here actually sort of goes in the opposite direction, the real risk-free rate from the nominal rate. Okay, so when you increase the nominal interest rate, what you do is you reduce risk sharing, okay, which raises precautionary savings motives in the economy. Okay, that's actually would actually happen even in a homogeneous economy. So if you take a regular representative agent economy, raise the representative agent's risk aversion, and increase precautionary savings, the real interest rate goes down. Okay. So people can argue over this, but I think most people would think that actually the real interest rate should go up. But that's just because, as you see here, that happens in every representative agent economy, from the simplest Lucas, 1978 kind of model. Usually we don't change risk aversion in such models, but if you did, that's what you'd see. But now with price rigidities, that effect would be overturned. So with price rigidities, inflation would not adjust, and in fact, the real interest rate, as under the new Keynesian model, would go in the same direction as the nominal interest rate. And that would actually amplify the effect that we have here. So I think we'll probably add that at some point. We have other work that we're doing thinking about the combination of financial stability and price stability. And in those models, we'll be able to work with both. But having that price rigidity would actually overturn this effect and amplify it. As I mentioned, the total cost of capital does go in the right direction always. So that's actually an analytical result. But it would go even more in that direction if it wasn't for this. Just a minor note also, I didn't talk in detail about this alternative, underlying channel that we could think of through deposit rates. But in that model, the way we've written it down, it also has the same effect as price rigidity on the real interest rate. So this particular effect is not necessarily, could go either way. The effect on total cost of capital goes always the way that I showed you, and so the risk premium. So I think actually rigidity actually helps, but it would complicate things and make them messier. So we chose at this point at least not to do it.
And you were mentioning about a targeting of the spread. Could you
Targeting the spread, you're saying?
you mentioned before that it seems that it is not just a target of the interest rate, but also the credit spread that the Fed might be doing. Could you?
So I think it's the model. The model has the issue about the spread is it's an equivalent way to look at what's going in the model. It's my point was it's the same thing, but the reason I bring it up is first it turns the constrained problem into an unconstrained problem. You don't have to even think about the constraint if you just think, well, they're not borrowing at the marginal dollar at unconstrained at the T-bill or deposit rate. They're borrowing it at that rate plus a spread. And so by controlling the spread, the Fed can control leverage. And I'm saying empirically, the reserves channel that we have gives you that prediction. It's consistent with that prediction. We don't think that that's the only channel driving that external finance spread. That's why we wrote down an underlying channel that instead works through a cost on the liability side. And there are probably other ones that are in effect too. This is something I think me and my co-authors at least empirically want to think about. What are all the potential channels that cause this? But if you take that as this, if you believe in this empirical relationship that I have here, and I find it very compelling, that the Fed funds rate seems to have very strong relationship with this spread. And if you think that if you buy the overall structure of the model, that you have banks as risk takers and depositors as less risk taking, then if in whatever way the nominal interest rate affects this external finance spread, then you're going to have an effect on risk taking and leverage and on risk premia. And you'll get everything else, including the dynamic applications, Greenspan Put, and so forth and so on. And my point then is to show this is not just to explain in another way what's going on in the model, but to show this graph, which to me I think sort of screams out that there is this channel here, because I think that no matter what you have in mind, once you affect the cost of borrowing for banks when they want to take leverage, it's going to have effects. And in particular, I think this graph is in some ways kind of quote unquote well identified in the following way. There are many things in the economy that drive risk premia potentially beyond interest rates and institutions and so forth. You have overall volatility, growth and things like that. So running regressions of risk premia on things is not going to precisely identify anything related to this channel. But if you believe that interest rates affect cost of banks levered leverage, then it's very directly getting at this effect. And that's what this graph shows to me.
Related to that, in the paper you mentioned that in a regression of the sensitivity of the Fed funds T-bill spread to the Fed funds rate is about 14%, and then you link that to the reserve requirement on net transactions of 10%. Can you comment a little bit on how that is related?
That's a statement about the model. It's consistent. Again, I think there could be multiple channels, so I'm not really sold on the idea that that's that it's all due to reserves requirement. It is consistent though in the following way. So look, for example, here at the Fed funds T-bill spread. Well, according to the model, the model is obviously a simple model, but that's just the reserve requirement times the nominal interest rate. So if you ran that regression in the model, you say, well, as I decrease the nominal interest rate by 1%, how much does the spread change? Well, it changes by the reserve requirement. In the U.S., now and historically, the reserve requirement on net transaction accounts, checking accounts, is 10%. If you run it in the data, it's a little bit bigger. The sensitivity is a little bit bigger. It's 14%. But I'm just saying in a consistent way in the model, it should be about 10%. So take that as kind of a benchmark. If you think about this deposits channel that I mentioned, then it would be something about how sensitive deposit rates are, the spread between deposits and nominal interest rates are to nominal interest rates. And there's been, other empirical work showing, things about that. But again, if you started from this point of view, then that from the spread point of view, then that tells you about how sensitive it is.
Thank you very much, Itamar. Anyone else who would like to take advantage of having Itamar here to ask a question related either to his current work or how that relates to policy? He's more than glad to take the questions. Meanwhile, one last question that I have, Itamar, you generate all these mechanisms through the reserve requirement. Would analyzing it with capital requirements will change in any way how the analysis should be performed and perhaps some of the results?
It's a good question. It's one we've thought about. I don't know if we've reached a definitive conclusion, but I think that capital requirements can. So let me say it this way. So we only have one asset, but if you had capital requirements, that would be like, if you have a riskier asset, then the relative amount of capital that you have to hold against it would be bigger. So if you change, think about the interest rate then as changing overall tightness of the constraint. And then to make sure that the constraint tightens equally across risky and less risky assets, you need capital requirements. Otherwise, to get around the constraint and take risk, you would always just buy everything in the risky asset. Instead, capital requirements makes you indifferent at the margin between a risky and a less risky asset, and then the interest rate moves overall how much risk you take. So if we had heterogeneity, if we had a cross-section of assets, we would use capital requirements to make sure you don't circumvent. We would use a cross-section of capital requirements, differences in risk weightings across assets. So that's what I should have said. Differences in risk weights across assets to write down the model that makes sense. If you just talk about capital requirement in this model with no differences across different types of assets, then I think you get the case that either this constraint binds or the capital requirement binds. If the capital requirement binds, then you don't want to take any more leverage in that region. Then this effect's not going to have any effect on you. If otherwise, it's going to have an effect. So if you really believe that the bank is always right at the margin of taking as much risk as they possibly can, then their problem is just very simple, and there's kind of nothing much more to talk about.
Oh, thank you again very much. So it seems that there are no more questions. What you can do is you can go to the seminar's webpage, and there you can get Itamar's paper, or you can go directly to Itamar's webpage and get it from there. So I really appreciate that you prepared this for us, Itamar. I just want to. No, yeah, go ahead. I just want to remind you that next week we'll have Anton Korinek from Johns Hopkins University talking about global cooperation.
Thanks for having me.
The week after we'll have Tim Kotner from Williams College, and then we'll have Timothy Flores, who joined us today in the seminar, who will be giving the last seminar in July. And then you can look at the full schedule there in the web page, and you can always find the papers that are going to be presented there, so that you can take a look at them in advance. And I'm going to share this recording with Itamar to ask for permission to share it, and after I got that permission, I will circulate it with everyone. Thank you very much. Thank you very much, Itamar.